Among the economies of the world, the Canadians are stated to have been one of the least affected by the financial crisis. Have they done anything in this particular area of mitigating housing fraud that may have some lessons for the United States?
I think there are a number of lessons from the Canadian experience, and this commission may want to even explore that. Of course, they have had problems in Canada, but not nearly as severe as what we've had in the United States. And I don't consider myself an expert with regard to their regulatory regime, how they do things in Canada, but it might be worthy of exploration.
Chairman Dodds, Senator Shelby, and members of the committee, I am pleased to present the Federal Reserve's Monetary Policy Report to the Congress. The U.S. economy and financial system have confronted some significant challenges thus far in 2008. The contraction in housing activity that began in 2006 and the associated deterioration in mortgage markets that became evident last year have led to sizable losses at financial institutions and a sharp tightening in overall credit conditions. The effects of the housing contraction and of the financial headwinds on spending and economic activity have been compounded by rapid increases in the prices of energy and other commodities, which have sapped household purchasing power even as they have boosted inflation. Developments in financial markets and their implications for the macroeconomic outlook have been a focus of monetary policy makers over the past year. In the second half of 2007, the deteriorating performance of subprime mortgages in the United States triggered turbulence in domestic and international financial markets as investors became markedly less willing to bear credit risks of any type. In the first quarter of 2008, reports of further losses and write-downs at financial institutions intensified investor concerns and resulted in further sharp reductions in market liquidity. By March, many dealers and other institutions, even those that had relied heavily on short-term secured financing, were facing much more stringent borrowing conditions. In mid-March, a major investment bank, the Bear Stearns Companies Incorporated, was pushed to the brink of failure after suddenly losing access to short-term financing markets. The elevated level of overall consumer inflation largely reflects a continued sharp run-up in the prices of many commodities, especially oil, but also certain crops and metals. The spot price of West Texas Intermediate crude oil soared about 60% in 2007, and thus far this year has climbed an additional 50% or so. Moreover, as the foreign exchange value of the dollar has declined, rises in import prices have put greater upward pressure on business costs and consumer prices. Effects. The economy continues to face numerous difficulties, including ongoing strains in financial markets, declining house prices, a softening labor market, and rising prices of oil, food, and some other. In the labor market, private payroll employment has declined this year, falling at an average pace of 94,000 jobs per month through June. Employment in the construction and manufacturing sectors has been particularly hard hit, although employment declines in a number of other sectors are evident as well. The unemployment rate has risen and now stands at 5.5%. In the housing sector, activity continues to weaken. Although sales of existing homes have been about unchanged this year, sales of new homes have continued to fall, and inventories of unsold new homes remain high. In response, home builders continue to scale back the pace of housing starts. Home prices are falling, particularly in regions that experienced the largest price increases earlier this decade. The declines in home prices have contributed to the rising tide of foreclosures. By adding to the stock of vacant homes for sale, these foreclosures have in turn intensified the downward pressure on home prices in some areas. Personal consumption expenditures have advanced at a modest pace so far this year, generally holding up somewhat better than might have been expected given the array of forces weighing on household finances and attitudes. In particular, with the labor market softening and consumer price inflation elevated, real earnings have been stagnant so far this year. Declining values of equities and houses have taken their toll on household balance sheets, credit conditions have tightened, and indicators of consumer sentiment have fallen sharply owing in commodity prices.
You talked about the long-term oil supplies are down. I believe that's what you said.
Well, not rising.
And is that domestically, worldwide, or both?
Well, certainly oil supplies are declining in the United States. Worldwide, they've been relatively flat.
Okay. Senator Menendez talked about the dollar and the value it has on oil. Does the budget deficit have any effect on the value of the dollar?
Perhaps a weak effect, but I don't think it's a first-order effect. The linkage between the budget deficit and the trade deficit is there because the trade deficit does reflect our national savings and investment imbalance. But empirically, the effect is relatively weak under most circumstances.
And the dollar is devalued by about 40%. Is that correct over the last four or 5 years?
No, I think it's more like 25%. And again, it has reversed a considerable appreciation prior to that peak in 2002.
Are you comfortable where the dollar's value is now?
I'm looking for the economy to strengthen next year, and as it does, I think that will support a strong dollar going forward.
Prices. Let me ask you this. There is one thing that's squarely within your realm, and that is the question of a weaker dollar. In 2000, we ran a budget surplus. Ever since then, the federal government has been running up larger budget deficits. We added to that a $1.6 trillion tax cut and a $700 billion war that would generally contribute to larger budget deficits. And if you look at that and you look at the twin deficits of both trade and the budget, in combination you have with a low domestic savings rate, you have all of the makings of a weakening dollar. In 2002, the barrel of oil cost $23 and 23 euros. Now it costs, Chairman had even a higher figure than I had. I had 145 and 90 euros. I'm sure it just changed overnight. Do you agree with the Commodity Futures Trading Commission and others that the weakening dollar has contributed to the higher price of oil as an elemental part of our challenge?
I do agree, and I said so in my testimony. It should be noted that the decline in the dollar from 2002 reversed an appreciation of the dollar that took place from the early 90s until that point, and it's related to the dynamics of our trade deficit, as you alluded to. In the late 90s and early 2000s, strong capital inflows drove the dollar up, but that made us less competitive and created a trade deficit. Some of that had to be unwound to bring us back towards a more better balance of trade, and in fact, we have been seeing considerable improvement in our balance of trade as the dollar reversed that increase. But we also import a lot of oil, and because we import it when oil prices rise, that also works in the other direction. It tends to hurt the dollar. So there's really causality going in both directions.